video is going to be about the different types of orders, limit orders, market orders, and trailing stops, why they're important, and how they go with using, how they go hand in hand with your spreads on your options. So what happens is a lot of people just put a market order in, and the problem with that is a market order goes through at the current price, whatever they're willing to give it away for. And so that's the whole reason behind these two columns here. You have the bid and the ask. So if you're looking at the 192 strikes and the bid is $9, they're willing to buy that option from you at $9, but they're willing to sell it to you for $10.15. If you put a market order in, you are going to buy it for this ask price. Well, the problem with that is the spread between 9 and 10.15 is $1.15. If you were to buy 10 contracts, you would be out $1,015 as soon as you enter the trade. So what you typically want to do is go to limit order, and you can put in a price in between these two, and then you would only be down 50 or 60 cents entering the trade. So you'd be down $500 when you go into the trade. You would have a $500 break-even point. So the reason I'm showing you this spread in particular because it's very far apart, and I don't trade spreads like these ever. I typically trade spreads that are like 20, 25, 30 cents because worst case scenario, I enter the trade at a 30-cent loss, but I typically put a limit order in where I create the price. So market order, it goes straight through pretty much as soon as you click it, but you're going to get a terrible price for the option. A limit order, it may not go straight through. Sometimes it does because the stock's constantly jumping around. I'm going to use a little bit better example. So we're going to go on over here to Intel, and as you see, when you look at the bid and the ask, the let's go with the at the money, so the 46 strike price. Your bid is 203. That's what they're willing to buy it from you for, and the ask is 240. That's what they're willing to sell it to you for. So if you put a market order in, you're going to get this price right here. But you also have a problem with market orders because what you get is slippage. And slippage is, say, a big order goes through, or the market drops really quickly when you put your order in, and it drops down, and then you end up paying $260, and it just drops down there for a second, and your market order goes through, and then it goes right back up to $240. That slippage is that 20 cents that it dropped just for a second, and your order just happened to go through at that point. So not only did you pay the ask, you paid more than the ask because of that slippage, and you really don't want that. So always use limit orders. I don't ever use a market order unless I'm like panic mode, trying to get rid of something, and something's drastically falling, and I just can't catch up with it with a limit order. I'll use a market order. But with limit order, the nice thing is, unlike a market order where it just goes through at whatever price they'll give you, limit order, you pick the price. So if you go down here to limit, see you go to market, and this box is not highlighted. If I go to limit, now this box is highlighted. So if I go and put in all my stuff, September 4th, strike price, 46, it's going to change my price for me. It's going to show the bid and the ask. It's going to fill in this box. Well, if you notice, it's at 205, a little bit higher than the bid, but nowhere near the ask. They're not going to give it to me for this price. So what I do is I go somewhere in the middle. So the bid is 20, the ask is the bid is $2, the ask is 240. So I'll go somewhere in between, say 220. What this does is I'm not paying the ask, because if I pay the ask, I'm immediately down the difference between these two. That's the spread. But if I put in 220, I'm somewhere in the middle. Typically it goes through, and now I'm only down 20 cents when I enter the trade, and I have a much easier break-even point to reach. So just imagine if you're constantly buying at the ask, how much money you are losing when you can be right here in the middle, saving 20, 30 cents here per contract. That's, a lot of money when you're trading, large options trades like 10, 20, 30, 40, 50 options at a time. So when you put this price in, it has to go through this price or better. It won't go in at 221, 222. It will only go through at 220, 219, 218. It's only at this price or a price that's better. And another thing I want to talk about, I don't typically use it, but I think it's underestimated, and I think it should be used more often. And I really don't think that many people understand how it works, and that is a trailing stop. And how a trailing stop works like a stop loss, and it is a stop loss, but how it works, it is a trailing stop loss. So what happens is, say you buy one call option on Intel, and it starts to take off. What you can do is, in this value box, it's automatically set at 10 cents, but you can go to whatever you want, to 50 cents, just for example, as the stock is rising. So say you put it in at 47 and the Intel goes up to 48. What this does is, if it drops to 50 cents, so if it goes from 47 to 48 and then it drops down to 47.50, it will trigger this and sell your option for you, basically protecting you from any large or quick drops in the stock. And how it keeps working, it just keeps following the stock up. So say the stock goes up $4 or $5, this trails behind it. If it drops 50 cents after it reaches $4 or $5, it'll automatically sell for you, limiting your losses. The downside about this is you'll get stocks that pull back for 2 or 3 minutes. You'll get stopped out, meaning your trailing stop gets triggered and it sells your option, and then the stock takes off again. So you do have that issue and that risk. But definitely recommend only using limit orders over market orders, because it will save you so much money. And you don't want to trade stocks that have large spreads, because you're immediately enter a trade at a loss. So why make that loss bigger than it needs to be?